Okay, now in the second video of chapter 24, we're going to talk about the methods for evaluating investment proposals in projects or various assets based on how much it's going to cost me, and then how much I'm going to get back. This time we're going to be looking at the methods that use, and it's really just one method that uses the time value of money. But before we can discuss this, let's talk about what the time value of money actually is. So let me pull this around here. Now here's the concept of the time value of money. If this is today, and over a period of time, if we had a certain amount of money, if we put money in the bank right now, say we put $1,000 into the bank right now, in 10 years from now, would we expect that to be still 1,000, or would we expect it to be smaller or larger? And it would actually be larger because it's earning interest. So what the time value of money says is that money will grow over a period of time at some certain interest rate. Another way to look at the time value of money is this, is that suppose that somebody owes you $100 and they said they'd pay you back in 2 years from now, 2 years. And they don't have to pay you back, and there's no interest. They have 2 years to pay you back. Let me ask you, if they offered to pay you $99 today, how about if I just give you $99 today and we'll call it even? Would you do that? And I think most of us would be like, well, heck yeah, I'd rather have $99 today rather than wait 2 years for $100. Absolutely. Would we take $90? Maybe I would. Would I take $80? I don't know. It depends on what the value of that money is to me. But notice, though, that as we bring back money back to the present, it gets smaller. It always does. When we're talking about the same amount of the same payment or the same account balance, in the future it's larger, and when we bring it back to the present, it's smaller. And that's because I always think of it as today's dollars are more potent than future dollars. So if we're talking about today's dollars, I don't need as much of them. But if you're going to make me wait for it, well, then I'm going to need more of them. So the amount grows as we go into the future. Likewise, as we bring those future payments back, that we bring them back at a smaller amount. Same thing with a lottery. I think a lottery, if you win, you don't hear much about the lottery anymore. When it first came out, you always did. But you may win $1 million. You hit the jackpot, and you're going to win $1 million. I think the way it's set up is they get to pay you over 20 years. They get to pay you $50,000 a year for 20 years. That's $1 million. Or you can actually take a lump sum, and that lump sum, they may give you $400,000 right now. And some people go with the lump sum. They don't want to wait for this. But notice that all of these $50,000 is into the future. That's $1 million. But if we're gonna bring them all back to the present, it's a smaller number. So that's what I want us to hang on to. The concept here is that the measurement of a dollar in today's amount is smaller than what it'll be in the future. Likewise, a future dollar, bringing it back to the present, will get smaller. It's smaller just because we don't need as much, because it's worth more to me now than in the future. I'll take $80 now. $80 is worth the same to me in today's dollars than $100 in 2 years from now. So that's the time value of money. So it does take into account the time factor that it's going to take to get money back. The other thing that we want to know about the time value of money is the discount rate. It's called the discount rate, sometimes called the hurdle rate, sometimes called the cutoff rate. And back in this example where we said somebody owed me $100, And would I take $99? Absolutely. I'm only giving up a buck. Would I take $90? I don't know. Yeah, maybe. Would I take $80? I don't think so, because we're talking about that I'm actually taking a hit. I am taking a hit by getting it early. From a company's point of view, this is called the discount rate. And the discount rate, companies don't have hearts and they don't have feels or anything like that. They're very objective. And the discount rate is the average, well, I'm going to say it's the cost of capital. It's called the cost of capital. So now when a company decides, okay, we're going to open up a shop and we're going to put equipment in it and that kind of thing, and this is going to cost $10 million to do, where are we going to get the money? Where's the company going to get the money to open this new outlet, this new store? Where's it going to get the $10 million? Well, it's going to come from one of two places. It's either they're going to borrow it on long-term liabilities, or they're going to sell common stock and take on new owners, get more people, more investors to invest in the company, and use that money for that. Now, does this have a cost? Yeah, and the answer is, of course. Well, now long-term liabilities, of course, we know that this is going to have an interest rate with it. So that's the cost of borrowing the money. How about the amount to the investors? Well, the investors are going to be looking for a return on their investment, of course, and they're probably looking for a dividend rate, and dividend rates are computed for companies, and we may say that the dividend rate, investors are expecting a 6% rate of return on their investment, and if we don't give it to them, we're going to have trouble. They're going to start selling their stock, and to borrow the money from the bank is going to cost us 8%. So what is my cost of capital for doing this project? Well, if we borrow the same amount as investors put in, the average is 7%. That's our cost of capital. Now, don't get wigged out. In this text, they always tell us what the cost of capital is. We don't have to compute it, but I just want you to know what it is. It's the cost of using borrowed money as well as investor funds to make things go. What's it going to cost me to get the money to do this project? And it's kind of a composite. It's like an average that I have to pay back to lenders and owners to keep everybody happy. That's the cost of capital. And that's going to be important because we need to know what the cost of capital is, because that's my discount rate. That's the rate I'm going to use to discount it back. So, as is usually the case, the best way to illustrate this is to put it to numbers. Okay. I've got a 1, 2, 3, 4, 5, 6-year project here. I'm going to invest $200,000, and I'm going to get back. Let's see. I'm going to get back $45,000 a year. Oh, it's an annuity, isn't it? At which point the salvage value will be, let's call it $30,000. Now let's step back to the last video. Can you calculate the payback period? Oh, pretty easily. There's an annuity here. So how many of these $45,000 years do I need to get through to get my $200,000 back? 200,000 divided by 45,000 is 4.44. I need to go 4.44 years. Could we do the accounting rate of return? And yes, looks like I'm going to depreciate this asset 170,000 divided by 6 years. That's my depreciation per year. Subtract that off, get my net income. I can figure it out. But let's look at the time value of money. We're going to use this what's called the net present value method. Net present value. Now this $200,000, that's in today's dollars. Now 45,000, I have to wait a year for that. And this 45,000, I have to wait 2 years for it. The third one, I have to wait 3 years, 4 years, and so on and so forth. So what I want to do is I want to, now 45,000 a year from now is not 45,000 now. It's going to be smaller if I look at it in today's dollars. And certainly this 45,000 is not the same as this 45,000 because this one's even further out. So what I want to do is I want to calculate the overall net present value of this project. And the way I do that is I bring back all the future cash flows. I bring them all back to the present. I revalue them in today's dollars. I'm going to bring them all back, and even this $30,000. Bring it back. First thing I need to know is I need a discount rate. What is the company's cost of capital? And they always have to tell us this. I'm going to say the cost of capital, the discount rate is, I'm going to go with 6%. That's the average composite cost of using borrowed money as well as invested money. That's what the creditors and investors are looking for in a rate of return. So now, how do I bring this back? And this is where we're going to introduce the time value tables. So let me do that. Let me go back to the text here. Okay, well, here's where I currently am using the time value of money. The tables are actually in the appendix. I'm going to close up chapter 24. And if you go down to appendix B, that's where the time value of money is. Now, we don't need to read this appendix. I think it starts off with these formulas. It's showing today and then future and these crazy formulas. We're not going to talk about the formulas. That's not what I wanted to talk about. I actually want to go to tables, and let's see where the tables are. Okay, we've got tables that make life much easier. We're right here in Appendix B, and I want to go all the way to the bottom. Tables. Now, this is the present value of $1. Present value of $1. And just along the rows, I'll indicate how many years out it is. 1 year out, 2 years out, 3 years out, 4 years out, and so on. And then the columns represent the discount rate. Now these tables are published everywhere. If you go on to Chrome and you type in present value tables, you're going to get 1 million hits. They're in every accounting textbook, every finance textbook. They are, and they're broken down. Some tables go to the 0.5%, 1, 1.5, 2, 2.5. Some of them, I imagine, even go to the 0.1, 1%, 1.1%, 1.2%. But for our purposes, we just have just the percentages. And these are called the present value factors, to be applied to $1. So if I wanted to know, using a 6% discount rate, what is $1 a year from now, 1 year from now? What's it worth today? We know it's going to be smaller, right? Bringing a dollar from 1 year in the future back at 6%, it's worth 94 cents to me right now, 94.34 cents. How about 2 years out? At 6%, $1 2 years out is worth today 89 cents. 3 years out, it's worth 83.96 cents. Notice the further out it gets, the further out it is, the more I have to bring it back, the smaller it is. What is $1 40 years out? It's worth not quite a dime, 9.72 cents. So the further out I have to wait, the less it's worth to me. Likewise, as my discount rate goes up, the less it's worth, because it's costing me money. So bringing back an amount from the future, and all we're doing is we're revaluating it in today's dollars. The further out it is, the smaller it's going to be in today's dollars, and the higher my discount rate, the smaller it's going to be in today's dollars. Now these those are the rates to be used for $1. $1. So if I want to know what, say, what $20 is 1 year out at 6%. Well, if $1 is 0.9434, $20 is $20 times 0.9434. We just multiply this times the amount. So what I'm going to do is you notice that we were using a discount rate of 6%, and I wanted to bring back these numbers at 6%. So the first one, let's see here. The first one here was this 45,000. 45,000 at 6%, 1 year out. What is that? That is 0.9434. So 0.9434. So this $45,000, 1 year out at 6%, what's that in today's dollars? We take 45,000 times 0.9434. And in today's dollars, and I'm going to round to the nearest dollar, that's only worth 42,453. Now, what's this 45,000? It's 2 years out at 6%. The present value factor, 2 years out at 6% is 0.89. 0.890. So that 45,000 times 0.89 is only worth 40,000. Oops, I want to do it in green. 40,050. Now take special note here. Even though these are the same amount, this one's worth less to me right now because I have to wait longer for it. This is the present value of $45,000, 2 years out, discounted at 6%. And we keep going down the line here. What is the present value factor of an amount 3 years out at 6%? 0.8396. You know what I'm going to do? I'm going to drop these numbers, the third, fourth, fifth, and sixth year in, right here. And that's what we do. It is 0.8396. Next one is 0.7921, 4 years out. Next one is 0.7473. That's 1 year, 2 year, 3 year, 4 year, 5 year, 6 years out is, I lost my place, 0.7050. And this one is also, this is at the same time, we get this 45,000 plus we get the salvage value back. So this one is also at the 6th year as well. So that's also 0.7050. So let me calculate these out. 45,000 times 0.8396 is 37782. Notice that as we bring them back to the present, the number gets smaller. The further out it is, the smaller it gets. 45,000 times 0.7921, 35645. 45 times 0.7473, 33629. 45,000 times 0.7050, 31725. And finally, this 30,000 times 0.7050. Now that sun's actually coming in, isn't it? Can you still see? Oh, I think you can see, yeah. 21150. Matter of fact, that kind of looks kind of pretty. Well, then again, maybe not. Well, I'm going to pause this and see if I can close the drapes a little bit. Oh, no.